So this is a trending corn that will amaze you.
We call it Maize, as that margarine commercial from about 35 years ago went.
Yeah, and that's where we came up with a name for it. Dan showed me this commercial from back then.
Yep, the bicentennial year, 1976, for those of you who were around back then.
So as usual, we'll go into a risk disclosure. Past performance is not necessarily indicative of future results, and there's always risk in trading futures and options.
Yep, I guess the other way of saying that is when you trade, you're going to lose money. It doesn't mean every trade you make you'll lose money or you'll have a very short career, but you have to keep in mind that there's a risk to every trade you make.
Yeah. So Dan Keegan, he started off in the option business in 1978. He worked his way up in the Chicago tradition. Dan spent 5 years as a runner, phone clerk, and he was also a floor broker on the CBOE. In 1984, he was backed by the legendary trader Steve Fawcett, adventurer Steve Fawcett, and began a 20-year career as independent market maker on the floor. He's also traded on the CBOT and Treasury bond futures and options in soybean oil futures, and he's a regular contributor to Futures Magazine.
Okay, Tony's had a little bit shorter career than I have had, but it's one equally immersed in trading. Actually, from his dorm room, he began his trading career. He's a Central Michigan grad, one of the Chippewas. So Tony, even from back then, started studying USDA and EIA reports to determine the current fundamentals in the market. And he's quite a young expert in technical analysis.
So we hope. All right, so this was actually extremely hard to find, but I found a chart of corn going back to 1900. Now, obviously, some of these prices, I think, the guy that created this chart, I think he probably, called and got a guesstimate for the prices, but it kind of gives you a decent representation of, where the corn market has gone since 1900, and then where we currently are in the market. Now, he made this chart in 2006. Obviously, we went drastically higher than, that in 2006. And I just think it gives a good representation of, where we've come, in the price of corn over the last 100 years. And for me, I think this is a little, indicative of, the population growth, that we've seen over, especially over the last 20 years. And limited resources.
And the worldwide demand.
Yeah, exactly.
It's no longer just USA. USA is a big exporter.
Yeah, exactly. So that's
products.
And that was kind of a big fundamental change, starting in the 90s.
And obviously the ethanol
mandate as well.
Mandate means that a lot of this doesn't even go into people's stomachs, but just goes into creating corn oil and energy.
Yeah, exactly. But so I just thought I'd throw it up there so you guys can see, where we currently are in the market and where we came from back then. And I deal with a lot of corn farmers and grain guys, and I think they all kind of remember this 1980 period, where you had this massive sell-off in the market, and I think with high inflation rate too, I think a lot of them were leveraged at the time, and I think that was kind of a world ending. But as you can see, it doesn't even seem that it's like a little blip in the chart. So I noticed we have a lot of different people coming in every week, so I thought I would explain the basics of Elliott Wave, and that's the whole premise behind what we're trying to look at in the corn market. Is it's all based upon Elliott Wave, and these are all I'm not making any predictions of the market. I'm basing everything off of Elliott Wave, and this is a basic wave structure. It's a 1, 2, 3, 4, 5 up, and so you can kind of see this is expanded on the right, showing our 1, 2, 3, 4, 5 up with longer term objectives. And so let's just go directly into looking at now we're going to be looking directly at the DEES contract. This isn't the continuous contract. This is December corn. So if you look on your chart, it's ZC Z4, and and so we're looking at new crop corn. And so you can see we've had, last year we had a pretty sizable sell-off in the corn market, and I've made my wave counts. Now I made 3 wave counts to kind of give you an idea that Elliott Wave isn't a perfect science. It's it's interpretive, and as you get new price data, you can change your interpretation. So, and that's what I was trying to show you, is that things, as the market gives you new information, you might change your Elliott Wave structure, or the current count that you were looking at in the market. And so that's what I wanted to show you, is that there is adjustments made during Elliott Wave, and a lot of people say Elliott Wave is always better after the fact, and I think that primarily is because there's the input of a person, and a lot of times people become biased and don't have maybe aren't changing what what the market is giving them new, and so that's why I wanted to show you. So this is my first wave count that I made of corn, I think 3 or 4 days ago, not too long ago. But I looked at the initial move down in the corn market as a 1 down, with my 1, 2, 3, 4, 5 labeled in here. And for me, that was a pretty clear wave 1 down. I can make a pretty clear designation for my 1, 2, 3, 4, 5. And then my wave 2, I felt pretty confident with as well. But this is where, for me, it got a little tougher and a little bit more difficult in trying to determine which was the wave. And so this was our wave 1 down and our wave 2 back higher. So this is where it's on the inverse, obviously, on this chart, but this was our wave 1 down, our wave 2, and our wave 3 for the corn market. So what you try and do with Elliott Wave is you try and use some of the hard rules to determine which wave we are in. And there's 3 different types of hard rules when looking at Elliott Wave. And I'll show you the 3 hard rules that I generally try and trade off of. So the first hard rule is that wave 2 cannot retrace 100% of wave 1. And that is this first move up. This is a wave 1 higher, and this is our wave 2 consolidation. And wave 2 cannot retrace 100% of wave 1, and if it does, then it's no longer a wave 2.
Then you just start fresh, right?
Yeah, exactly. Then the original idea you have is now wrong. You want to be out of the trade and trying to come up with a new interpretation of the market. So going back to what I was talking about here, so this is our wave 1 down. Our wave 2 did not retrace 100% of wave 1, which would have been back up to I think like 615, 610, somewhere in there. And wave 2 did not retrace 100% of wave 1. So that validates, for me, and Elliott as a wave 2 because it did not retrace 100% of wave 1. The second hard rule we have is that wave 4 cannot enter the area of wave 1. And that is illustrated here. So this wave 4 consolidation cannot go into the lowest point when looking at the corn market, the lowest point of wave 1. So going back to this corn chart over here, so my wave 1 ended roughly at 530. So my wave 4, under Elliott Wave, which appears to be the market is currently in, wave 4 cannot retrace into the wave 1 territory, which would be this 530 territory. And if it does retrace into that 530 territory, the wave 4 that you thought you have is not now a wave 4. And
what is it then?
So you could be starting an uptrend in the market, and that's what I'm going to show you next. So say the market does rally into wave 1 area, this wave 4 that I think we're currently in under Elliott Wave, then you could make a case for maybe the market has currently made a bottom. So here's another count possibility. Looking at the corn market. For me, again, this is just hypothetical. But for me, this count didn't work out as smoothly as you normally would like. So as you can see, I moved. So in my first count, I had this long move down here as my wave 3. And generally, wave 3 it's never the shortest. That's the other third hard rule that we have. So wave 3 can't be the shortest. It doesn't necessarily have to be the longest, but it can't be the shortest. And so this would kind of validate some of that. But I think the biggest issue that you would have with this labeling would be your wave 4 here entered the territory of wave 1. So that's why I didn't believe this is our true Elliott wave count for the corn market. But if this corn market does go above this 530 level, this could be, the alternate count for the market. And that's why I want you guys to think about it. There is no perfect science to trade, and there isn't some magic formula that's going to give you all the answers. But I do believe Elliott wave helps you simplify the market and gives you a better way to look at the market.
Gives you a starting point.
Yeah, exactly.
Right. For
it gives you
a place to pivot off of.
Yeah, exactly.
Gets you trading.
Yeah, and it gets you involved in the market. And so this is what I determined as our current wave counts. Based on my previous possibilities of the wave count, I believe this is our true wave count for the corn market as it currently sits. And so I believe under Elliott wave, this was a wave 1 down, or wave 2 consolidation, and then this big massive move lower that we had basically all year last year was our wave 3. And wave 3s are usually pretty sharp, and I think that's what classifies this as a wave 3 for me. So this is our wave 1 down, wave 2, our wave 3, 4, and our 5th wave, completing the third wave sequence. And so the other thing you can try and do is to use the hard rules to your advantage. So under this, after you get a 5th wave completing under Elliott wave, you look for an ABC consolidation. Now those consolidations can differ every time, and that is actually another rule of Elliott wave, is the wave 2 consolidation is always different than your wave 4 consolidation. So as you can see, we had kind of a choppy and sloppy wave 2 consolidation. So under wave 4, I would look for a much smoother consolidation versus the wave 2.
Now, does that, when smoother, does that mean would last shorter or longer, or that wouldn't necessarily?
So there's different types of consolidations, and that, for me, this wave 2 consolidation would be considered an expanding triangle. And when I say smoother, I would expect a much smoother ABC consolidation. And we can go back and I'll show you. So for me, this would be a smoother ABC consolidation, would be this type of consolidation in the market. So I would look for something similar to this versus an expanding triangle like we had in wave 2.
Mm-hmm.
And so as you can see, I would think this is a wave 1 or a wave A higher. Next, we would be looking for a B wave lower. So this would be our A wave higher. Next, we would look for a B wave lower, and then look for a C wave, completing our 4th consolidation within the market, and then look for a 5th wave lower. And so using Elliott wave as kind of a guiding point, this 530 level will be a key level for me, if we're getting close to there. And I think that could present maybe some opportunities within the market. And you would have to be very cautious about if it got over that level. The idea of that wave count is now would be wrong if you got above that 530 level. And so this is what I'm going to be looking for in the corn market, over the next 2 months or so.
So what direction does Elliott wave theory seem to be projecting in terms of a market direction for corn?
Yeah, I got you. So a fourth wave is a counter trend move. So the ultimate trend of this market is currently down. So we would be looking for a little bit higher prices if this is a fourth wave consolidation under Elliott Wave. We would be looking for a little bit higher prices that ultimately would still fail and result back down to the trend.
So it would go up initially and then plummet? Or
I wouldn't say plummet, but yeah.
Descend.
Yeah, exactly.
So it's going to go up. It's not going to start out going down and then continuing. The way you're looking at it, it's going to go up temporarily, maybe a little bit,
yeah,
and then start its descent.
Yeah, exactly. And maybe if you're looking at, I'm not necessarily big on the fundamentals, but maybe based on my Elliott Wave interpretation, using some of the current fundamentals, maybe when we get towards planting this year, maybe we get some big hiccups and, we start talking like we can't plant the crop. And then eventually we do plant the crop, and that's where, you would start seeing lower prices if this is a fourth wave consolidation. And so for me, this kind of gives me a good starting point for the market. Once I made this initial wave count, it felt like, the doors is open and I could see clearly into the corn market. So that's how I try and use Elliott Wave to my advantage. And like I said, there's no perfect science to this market, or trying to trade in general. There's always risk, when you're trading. But I think this gives me a good starting point. And so the next thing we're going to be looking for in this December contract would be for a B wave, a little bit lower lows. And upon completion of that B wave, we would be looking for a C wave higher. But kind of to describe how Elliott Wave can be tough would be as if this isn't an ABC consolidation, and maybe it's a wave 1 up, a wave 2 down, and then a wave 3 higher. Just to kind of give you an idea that you can. For me, that's the biggest risk when trying to trade off of Elliott Wave. Is it a 1-2 or is it an ABC consolidation? And I think that's always the toughest spot for me. Is my original wave count correct, or am I looking at the market wrong? But again, you have to go back to the hard rules. There are a lot of there's a lot of interpretive rules in Elliott Wave, but I believe you try to improve your odds by using some of the hard rules under Elliott Wave to improve some of the probabilities. And so this is the type of move that I would be looking for in the corn market. And I think for me, I like getting more data to help me determine if my original idea is correct. So if this is a B wave down, we would want to see a lot of zigzags if the market does go lower. To be honest, I do believe the whole move is, so the question was, why couldn't the whole move down be an ABC consolidation?
That's a good question, Frank.
Yeah, that is a good question. And to be honest, I do believe the market is in an ultimate ABC consolidation. And as you can see, I drew it in here on this first chart. So this is our original move A down, our B move back up, and then our C wave lower. And I was going to kind of lead it out there that I have a further interpretation of the market, and that's what we're going to be looking for next. But under a C wave lower, you also have to have a 1, 2, 3, 4, 5 to complete that C wave lower. And that's what I'm going to be looking for next, is a completion of the 5th wave lower. And I believe you could see the market under Elliott Wave trade higher off that 5th wave completion lower. And so that's ultimately what I do believe the market is in an ABC correction, ultimately set up for higher highs. And I've been talking to some grain farmers all year, and that's kind of been my interpretation of the market. Is if this Elliott Wave count is correct, in the intermediate we could be seeing lower prices, but I think that could set up a good potential longer term in the market. And we will be revisiting the corn market because I think this is a good Elliott Wave count. To be honest, soybeans for me are kind of a tough thing to try and make a determination off of. So we will be revisiting the corn chart under Elliott Wave, in probably 2 months or so, and we can, try and count out a 5-wave decline if this 4th wave does stand to be true. And so that's what we're looking at in the corn market. And
now we're going to look at an option strategy
yeah,
that might incorporate some of what Tony's been talking about with the movement of corn.
And I mean, for me too, the sentiment was extremely bearish, coming into this end of the year. And I think the market was deserving of a little bit, of a short covering rally, or, a little bit of a testing of people that were short. That's kind of how I look at, when the market goes against the trend, it wants to test the will of the people that are still short the market. Do you still want to stay short here? Because, you might be giving back huge profits, and that's kind of the risk in trading futures, is the high leverage. But we'll look at some of the option strategy. So we were looking at the April options and the May options, which are serials of each other, and I'll let kind of Dan take over.
They
now.
both flow into the May futures contract. The April ones expire in 16 days, and the Maize expire 35 days, 5 weeks later than the Aprils. Okay, so they both flow into the same futures contract, so there is no curve problem in trading the two. Okay, so one we're looking at here is we buy the April 465 puts, which gives you the right to short the May futures at 465. So should that go in the money, that's what ultimately would happen. You'd be short the futures at 465. If it keeps, we're around 482 right now, so it's not really close to it at the moment, but it could obviously get there. Okay, so that's our long option that we're going to do. The short option we're going to try is shorting the May 450 puts. Okay, so the April 465 puts cost 3.25, and the May 450 puts, they're 6.5. So the net premium is going to be a credit of 3.25 for this trade. Okay. Can anybody tell me where if this was at April expiration, which would be the absolute worst spot for this spread to be? Okay, Larry's correct. It is 465, exactly. Because with every spread, you want your long to go as high as it. In case of a put, it can't go to infinity, but if the corn for some reason went to 0, which of course it never would, but if it went to 0, then your put would be at its maximum value. Okay, you want what you're short to go to 0, and you want what you're long to go as high as it possibly can go. So if it goes right to 465, that's the death zone for this spread. Okay, because what your long is going to be worth 0, but then the May 450 puts will pick up some value, because even though it's gone 2 weeks worth of time, instead of being at 482, it's now 17 points lower at 465. So our long that we paid 3.25 for is going to go out worthless, and the put we sold at 6.5 is probably going to pick up a couple points. So to be at least, we're not really sure how much until we know what the supply and demand is of the options at that time. So it would be like we lose 3.25 on our long, and we'd probably lose 2 or 3 on our short. Okay, so that would not work out. But let's look and see if it went. Let's say it goes all the way down to 450. Okay, that means the put we bought for 3.25 would now be worth 15. Now the May 450 puts obviously would be worth more than 6.5, but this spread would be a winner. Okay, at that level. And the further down it went, it'd be even a bigger winner. Okay, until it gets to a certain. Obviously, they cancel each other out. The short put because if you're short a put, that means you are giving somebody else the opportunity to get short at 450, and you'd be long the futures contract. And the 465 put that you exercise, they would cancel each other out at some point, but nobody's going to exercise until May. So if it keeps going down, that 465 put is in the money. You're going to be short a futures contract against short the May 450 puts. And that's actually equivalent to being short a May 450 call. So the further we go down, the better, because at some point that May 450 call will become worthless. Okay, so that would be good. Now, if it just takes off and keeps running to the upside right here at 42, let's say it gets up to 500. Okay, the 465 put we bought for 3 1/4 obviously is going to go out worthless, but the 450 put is probably going to be worth about 1.5, 2 points, when you say something like that. So it'd be a winner in either direction. You just don't want it to settle in the 465 range.
Yeah.
But if it, let's say it does go down to the 450, 445 range, so we're at that point we're short the May 450. In effect, we're synthetically short the May 450 call. Now, you said at that point it makes a dip down. It could make a move up, according to Elliott? Or?
Yeah, exactly. We're looking for a B wave lower and then ultimately a C wave higher.
Okay, so in that case, what we could do is maybe buy a couple of 460 calls, okay, for one thing. So it zooms up, and you're long twice as many calls as you are short. Obviously, the bad point of that spread would be if it went up to 460 and sat there, and you'd be short 1 450, 1 460 call spread that would max out, and your 2 longs would go out worthless. Okay, but if the further it goes above 460, remember you got that 2 options that you'd be long for each one you're short. So that's one way of looking at it. Another way, you could maybe buy a 440 call at that point.
Yeah, if the market dips low enough.
Market dips low enough, and you'd be buying the 440 call for about the price you sold the 450 call.
Yeah, exactly. So, and this is just kind of a different way to look at options. Dan likes using serials and kind of establishing original positions and then building upon that as you get more information in the market.
Right. That's just your beginning. Most of these books about options, it shows you, well, I put my position on what does it look like at expiration. But in reality, if you really want to do well or have your best chance of doing well, you want to be constantly adjusting and tweaking the risk, because there's always a point of risk. So the more risk you can shave off your position, the better over the long haul you're going to be.
Yeah. And, so Dan has kind of taught me a different way of looking at options. I look at trading futures a certain way, but he looks at options as like a trading mechanism versus trying to trade the chart. He's trying to trade the option. Right.
You look, and a lot of things you want to look at, too, is just the amount of time value that's embedded in the option premium. I know the big announcement's coming out Monday. Is that right?
Yeah, the 10th. So
the 10th, the USDA report. Now, typically going into that report, you're going to see the premium level a lot higher for all the ags.
Yeah. The market tries to basically guess the move and make sure people can't make money.
Mm-hmm. And
sometimes they're wrong, sometimes they're right.
Yeah, you really don't know, but uncertainty is what pumps premium into options. And until that USDA announcement comes out, there's a certain degree of uncertainty. A little bit later in the summer, it's going to be a little bit more dramatic. Right?
Yeah, exactly.
But even now, it will have some effect. Okay. And now then you have to ask yourself, if you're looking at that report, the premium levels are high, I could figure out a way to try to sell those premium levels. But if it does make that big move, then you're going to lose out on that. So it's a,
double-edged sword.
Double-edged sword. So you don't know if the premium is definitely going to drop after the USDA announcement.
For instance, like the April contract that expires in 18 days, currently the straddle, so selling the put and selling the call, is about 20 cents. So option traders are predicting from today the move on Monday would be roughly 20 points. And if it's outside of that range...
In either direction.
Yeah, exactly.
20 points in either direction within the next couple of weeks.
Yeah.
So that's kind of implying how large the future move in the corn futures will be.
Yeah, exactly. And sometimes they're wrong. Maybe, limit in corn is, 40 cents. So the option trader is only predicting 20. If the market moves 40, then the option trader is wrong in that case.
Okay, here's from Larry. He's asking, if you think the market is going lower in the near term, why are you selling the May put now, which will add risk to the position later on? Okay, the reason is because we're buying a higher strike April put. So if it goes down, that's fine. Okay, we want it actually to keep going down so that that put kicks in, it's in the money, and our short put is then converted into a short call, which in a down move is it's a positive thing. Does that answer the question, Larry? Okay, thanks, Larry.
All right.
Does anybody have any other questions they'd like to have answered?
Any questions maybe about corn markets or, I know maybe some of you guys are producers, or, do you think this provided a little bit of assistance or help? Well, I think that will conclude our webinar for today. And like I said, we are going to be revisiting the corn market and making further interpretations under Elliott Wave, where the corn market, looks to be. So look for that in 2 months or so. So we have a question
from Marvino. Do you ever trade verticals in corn options? Yes, all the time. Yeah. Whether they're one-to-one verticals or whether they, this one, the spread we just did, it was kind of a time spread, but it's kind of like a combination of a time spread and a vertical, because we got the 465 and the 450, so they're kind of
yeah, they're vertical.
The vertical, so in other words, it's
15 cents apart.
It's locking in our profits and losses within that range. The different calendar months makes it a little bit different, but yeah, definitely, I think. Me personally, I like to just trade spreads all the time.
And that's kind of your initiating position, and then you build upon it?
Build upon it either using other spreads or maybe an individual option. You just kind of constantly molding it, locking in, hopefully, or minimizing losses, whatever you have to do to up your possibilities.
I mean, how many times would you say you normally trade in an like, say you put on a one put vertical? How many times would you trade around it? Like once or?
It all depends on what happens with the market action. If the market's just sitting there and it's a position that benefits from that, you may not do anything at the moment.
Okay.
You just sit there and enjoy it. So
I got you.
One of those rare opportunities that you can sit back and enjoy your position working for you.
Okay.
So.
Well, I think that'll conclude the webinar unless anybody else has any other questions. And as always, we're full-service brokers here. So if you guys, need some assistance in trying to trade the market, or want a different opinion, feel free to give us a call or send Dan an email anytime. And
it's been fun today. Hope you enjoyed it, and hope you come back next week.
Yeah. So we do this webinar series every Wednesday at 3:30 and
Central Time.
I think next week we're going to do it on the S&P. So. If you guys have interest in trying to trade that or look at the market, feel free to come and attempt.
Yeah, and if you have any questions about the S&P and the options, come prepared.
All right, you guys have a great weekend, and hopefully we'll see you next week.